Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at two AI-focused stocks to consider buying on the dip and holding that are not named Nvidia or super microcomputer. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for a look in some of our services, portfolios, and more. And just quickly, those two stocks we're looking at today are Vertiv, which trades in the ticker VRT, and Constellation Energy, which trades in the ticker CEG. And before we jump into those two stocks and why they might be considered or worth buying on the dip at the moment as broader AI plays, let's just quickly go over where the market stands. I'm recording this on mid-afternoon on Thursday. So at the moment, we saw the inflation data come in on Wednesday. That was the big news. And then the Fed and Jay Powell's speech. So we'll just quickly go over that and then kind of look to see what might be next around the corner. So the inflation data was hardly spectacular, but the fact that it didn't come in hot was all the bulls needed to justify sending the S&P 500 and the NASDAQ to new records. As expected, the Fed also kept its core interest rate unchanged. And the central bank also now projects roughly one interest rate cut in the back half of 2024. The Fed meets 4 more times this year: July, September, November, and December. And Wall Street's currently placing a roughly 60% chance that Jay Powell and co. make their first rate cut at that September meeting. Powell has remained relatively steadfast in his rhetoric around inflation, saying the fight's far from over. He's trying to remain cautious, saying yesterday, around Wednesday, that, quote, we'll need to see more good data in order to cut rates. The Fed boss is never going to declare a premature victory over inflation. He's trying to learn from past mistakes of previous Feds, and he knows that declaring victory over inflation will only lead to higher stock prices, which goes against his fight against inflation. And they still have a long way to go to get to that 2% floating target, but it's pretty much guaranteed that the next thing that the Fed will do is going to be to cut rates. So that's all that Wall Street cares about. And on top of that, they're really looking at the really impressive earnings growth for the S&P 500 and the tech sector. If you look at just tech margins for S&P 500 tech stocks are projected to reach all-time highs of 24.8% in 2024. So this year, blowing by 2023's record of 23.4%, which was a new record at the time, which topped previous records from several years ago. And then tech margins are set to hit nearly 26% in 2025 and 2026. And overall S&P 500 earnings are projected to climb 9% in 2024 and then another 13.4% next year. So that earnings outlook, the impressive tech margins growth boosted by all this AI spending and the fact that the Fed is likely to cut rates at some point in 2024 is leading to this really bullish market case. That said, in the near term, we could see the market pull back a little bit. The NASDAQ's trading solidly above its 21-day and its 21-week moving average, and at some of its most overbought RSI levels over the last decade. So we could see a near-term pullback, and I encourage all investors with longer term outlooks to look at some of these longer dated or shorter dated moving averages. And when the market does pull back, to either buy into some of these big market tracking or index tracking ETFs or some of your favorite best in class stocks, and just try to not time everything precisely, but looking for these pullbacks that occur regularly at healthy intervals for the broader market in every stock you're buying and selling. So worth looking at that at the moment. And with this in mind, as we head into the deeper part of June and look ahead to the summer, we're going to take a look at two of these somewhat beaten down AI stocks to consider buying on the dip, that, as I said, that are not named Nvidia or super microcomputer. In the first of those two stocks we're diving into today is Vertiv, which trades the ticker VRT. So the artificial age is dawning, and Vertiv provides critical digital infrastructure and continuity solutions, and it looks ready to blossom into a potential Wall Street star. It's already been on a massive run over the last few years, which we'll touch on. Vertiv will grow alongside the continued expansion of nearly endless data in the AI supercycle. No matter which companies, say Nvidia or some other company that is not really on the radar just yet, come to dominate the more forward-facing world of artificial intelligence. The stock has soared since its early 2020 IPO, and it's outpaced Nvidia over the last 12 months. And it even has a partnership with the AI chip powerhouse. So let's dive a little bit deeper and then go into some other fundamentals after that. So the world is built on big, instantly available data, and Vertiv's job is to keep all of that computing power needed to drive the modern economy running as smoothly as possible all around the clock. So they provide the behind-the-scenes tech that keeps everything working properly and running smoothly via hardware, software, analytics, and other services. Its portfolio of power, cooling, and infrastructure solutions and services operate across data centers, communication networks, commercial and industrial facilities, and beyond. Its product categories include critical power, thermal management, racks and enclosures, monitoring and management, and more. Its chief executive has said many times over the last year that the firm is benefiting from the wider artificial intelligence boom, and it expects to push for greater energy efficiency across data centers, which is a big boom for its liquid cooling technologies, as more traditional air cooling systems cannot as effectively cool these new high-density racks that are jam-packed with GPUs and CPUs. Vertiv and Nvidia are officially partners to help solve some of the future data center efficiency and cooling challenges. On top of that, Vertiv's micro data centers offer all-in-one solutions for various power, cooling, monitoring, and more. Vertiv is set to really grow, as I said, just alongside the broader expansion of big data and AI, and that's being showcased in its stock price performance. So the company went public in early 2020. It posted 14% revenue growth during the first full 2 years as a public company. Then it grew its revenue by 21% last year, and it grew its Q1 2024 organic orders by 60%. And closed at a record high backlog of $6.3 billion. So looking ahead, we're calling for roughly 13% growth on the top line this year, and then another 12% growth next year to go from about $6.9 billion in 2023 sales up to $8.6 billion in 2025. So a nearly $2 billion jump on the top line over several years is impressive. And then on the bottom line, we're calling for 37% adjusted earnings growth in 2024, and then another 29% growth next year. This bottom line growth would come on top of over 200% adjusted earnings growth in 2023. And the firm has continued to raise its earning outlook over the last few years, and its big beat raise quarter in the first quarter extended a stretch of really impressive upward earnings per share revisions. So the overall outlook for 2024 earnings for Vertiv is up 64% over the last year, with its outlook for 2025 up 61%. And as I said, this is part of a year-plus trend of its earnings outlooks essentially going straight up. And its recent activity helps it land a Zacks rank number 2 buy. And taking a look at the stock price performance, the stock's up about 250% in the last 3 years, and 877% in the past 2 years, and 300% in the last 12 months. This blows away Nvidia's 200% run. Thankfully, the stock is cooling off a bit. Vertiv is trading around 15% below its highs at roughly $92 per share as it record this on Thursday afternoon versus its all-time records in late May of $109 per share. The stock is trying to hold its ground right around its 50-day moving average, and it's at its lowest RSI level since October. If you're a long-term investor, you don't necessarily need to time it any more precisely than that. But if you're trying to look at a little more technical pullback, if you want to possibly wait for it to maybe fall back to the 200-day, which is all the way around $62 per share, that would be, in my opinion, a screaming buy opportunity. But it's trying to hold its ground right at the 50-day at the moment. So worth considering it now as well. And it might need, though, to cool off a little bit more. It's trading at 32.9 times forward 12-month earnings, which is near its highs. This is versus Tech's 27 times, and its median since it went public of 18 times forward earnings. But its PEG ratio, which factors in that longer-term earnings growth outlook, marks a solid discount to Tech at 1.3 versus 1.8 for the broader Zacks tech sector. So overall, big data and computing power are growing exponentially in the rapid rise of AI, cutting-edge technologies, cryptocurrencies, and more all require a gigantic amount of computing power and energy. And Vertiv's job is to make sure that the lifeblood of the economy is running at peak performance without fail. And this is really no wonder that 10 of the 11 brokerage recommendations that we have for Vertiv at Zacks are strong buys. The company also pays a dividend. It's repurchasing stock, so it's certainly worth considering Vertiv as a long-term kind of picks and shovels play into the world of AI and big data. Just as a note, I do own Vertiv in my own personal portfolio. So certainly worth considering putting Vertiv on your watch list as we get deeper into June and the summer months. And next up is Constellation Energy, which trades in the ticker CEG. Constellation Energy is a nuclear energy powerhouse that produces roughly 10% of all clean energy and renewable energy in the U.S. The firm's nuclear power facilities, alongside its much smaller hydro, wind, and solar units, power the equivalent of 16 million homes. Constellation is benefiting from the energy-focused aspects of the Inflation Reduction Act, which essentially provide a price floor for nuclear power. It helps put it on a level playing field with other clean energy sources. Most importantly, nuclear energy provided 50% of America's carbon-free electricity in 2023, making it the largest domestic source of clean energy as it has been for a very long time. And most importantly, the once shunned industry is primed for a transformation into one of the powerhouses of the global energy transition. The U.S. co-led in early December 2023 a coalition of over 20 countries from 4 continents that pledged to triple the nuclear energy capacity by 2050. Overall, the rich world especially has done an abrupt 180 on nuclear energy. The industry appears to be ready to take its place at the top of Wall Street, given its ability to revolutionize the global economy as more rich of the rich world is trying to slowly transition away from fossil fuels. It's worth noting last week, the U.S. Energy Secretary made 2 different pro-nuclear energy comments, first in Georgia at the site of the 2 newest reactors in the U.S., and then she doubled down later in the week in an interview with Reuters, saying that the Biden administration has been talking with big tech firms about coming together to help push forward new cutting-edge nuclear reactor technology and possibly placing orders altogether to help reduce costs. But overall, the company stands to benefit from the growing push of big tech companies to transition away from fossil fuels right at a time when they're trying to spend heavily on big data and AI, which is requiring more energy than ever. So that is why Constellation has been one of the best performing stocks of 2024, as more and more people realize that nuclear energy is going to be playing a really big role. So now let's get back to Constellation itself, which is poised to improve its current nuclear power plants, kind of get them up to date again. Lots of them around the country are pretty old at this point, and some of them have been just neglected. So keep them up and running as long as possible. The company is also aiming to expand into the next generation of these reactors, which are called SMR, small modular reactors. The firm is also ready to grow through mergers and acquisitions and return more capital to shareholders via buybacks and dividends. Constellation stock has soared since its early 2022 IPO following a spinoff. The stock then went on a wild run in February of 2024 after it announced plans to grow its dividend per share by 25% in 2024, exceeding its 10% annual growth target. On top of that, it's targeting long-term base earnings per share growth of at least 10% through the rest of the decade. The stock has then soared for the first 5 months of 2024, lagging only a few of the pure play AI stocks in terms of S&P 500 names. Overall, the company is set to grow its bottom line by 52% in terms of adjusted earnings in 2024, and then do another 14% growth on the bottom line next year. And if we look to its earnings revisions trends over the last year, its outlook for 2024 is up 35% over the last year, and its 2025 earnings estimates up 50% for Constellation. So that just shows it's trending heavily in the right direction, and its near-term estimate revisions are up big, with its outlook for Q2 up 20% and its outlook for Q3 up 28% since its last report. This helps it land a Zacks rank number 2 buy at the moment. And like with Vertiv, this is part of a extended run over the last year plus of its earnings revisions trending pretty much straight up for the nuclear energy powerhouse. So it's benefiting, as it's said, from its standing in a crucial and growing industry that has a potential to become a real power on Wall Street. On top of that, Constellation's really benefiting from its ability to increase its bottom line, pay a dividend, and the fact that there are not that many viable nuclear energy companies that the average U.S. investor can buy right now. It's just there's not that many after decades of kind of stagnation in the industry. We're turning a new leaf, and it's going to be a new age for nuclear energy. But at the moment, Constellation and a few other names are really the only pure play stocks you can buy. So it's benefiting from it standing there as well. Its shares have soared 275% roughly since it went public in early 2022, following a spinoff. That includes an 84% year-to-date run, and the stock is currently trading around 9% below its recent highs. As early as Wall Street started taking profits in early June, Constellation recently popped up off of its 50-day moving average. As I'm recording this, it might slip back. It was down Thursday afternoon as I'm recording this. So that 50 days is something you could be watching for. It's already gone from heavily overbought RSI levels at various parts of this year so far to roughly neutral. So that's a good sign. And of the 12 brokerage recommendations that we have, 8 are sitting at strong buys, with the other 4 coming in at holds. Overall, the build out of the nuclear powered economy will cost tens of trillions of dollars over the next several decades. And the sheer costs and timelines mean that investors, especially investors who are getting in now, have the opportunity to essentially get in near the ground floor. Even though a company like Constellation in stock has gone on a big run so far, it's certainly just at the beginning stages of a really new energy world that could be playing out over not the next decade, but the next, say, 50 years or more than that. So Constellation appears to be worth considering as a play on compounding mega trends such as AI and nuclear energy, which is going to be fueling a lot of the big energy needs of AI and the constant growth of data in the US and around the world. So that does it for this episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.